Good morning, everyone, and welcome to the AgriVisor podcast. We're going to discuss the USDA Outlook Forum that we got some numbers from both yesterday and this morning. I'm Joe Camp, the Risk Management Specialist at AgriVisor, and with me is Dale Dirkholz. As usual, we'll tell you a little bit about AgriVisor. Hopefully you folks are familiar with us. Of course, if you received the email invite to this webinar, you likely get our communications, but please check us out at agrivisor.com to learn more about the services we provide to the Illinois Farm Bureau and the Iowa Farm Bureau as well. We're going to jump right in here and talk about these new numbers. These are new crop numbers from the USDA, those folks meeting in Washington yesterday and today, as I mentioned. And first look was given to acres, certainly. And you have in front of you the numbers for the major 8 crops. And the most notable number here, at least the number that the trade has certainly taken note of, is that corn number that we have, 90 million acres. That's up 2 million over last year. Soybeans down fractionally, down 200,000 acres. That was not a friendly enough adjustment to get any buyers really interested. And so we've seen yesterday and now today the grains slipping in price here. Dale, you have mentioned at the beginning that, okay, we've got a 2 million acre increase on corn. That's almost all the way offset by the reduction in the minor feed grains, the rest of them.
Right. That's the one thing that the trade really didn't talk about or pick up on when we got these numbers yesterday morning. They looked quickly at the major crops, the corn, soybeans, the wheat, and really didn't delve off much in any other direction. And we have about as much of a drop in the acreage of other feed grains out there. And I think primarily grain sorghum that somewhat offsets the corn. But still, the acreage as a whole being down, and you can see, the total of 8 crops here is off about 2.5 million acres from what we had last year. And you're going to find it, if you factor back to a more reasonable prevent plant, the decline is going to be even steeper. We'll talk about that in a second. But still, it leaves us, as you'll see later, going through these S&Ds with potentially comfortable crop scenarios going forward. So it really is putting the burden at this point in time on the need to really have some yield adjustments to the downside here to trim back supplies a little bit. They aren't necessarily what we'd call burdensome, but that's where the energy is going to have to come. The other thing you need to understand about these numbers, they are no way driven by a survey of producers at all. These are basically USDA analysts taking a look at what their crop models tell them, and looking at anecdotal evidence, looking at farm economics, looking at the economics of one crop against another to come up with an idea, of what acres might ultimately do. In that respect, probably even starting today, in the mail, producers should be getting the survey for that March 31 prospective planting report. So, this kind of gives us a peek at what people really think, given what we know today. But the report coming roughly a month from now really is going to be the one that's going to tell the tale. And with farm economics as they are, and with crop economics as they are, you really wonder if we might not lose more acres than this yet, at least indicated on that March 31 report.
Okay, we'll move on to talk about acres relative to farm economics, but leaving this slide, we'll just reiterate, Dale, your point that these acres numbers are certainly not set in stone. They do provide us with a first look, but we have, in the past seen that the USDA can very well overshoot. And in fact, in the past 10 years, they've overshot acres on this report more than they have fallen short from the final estimate. So not set in stone, and we'll look forward to that March 31st report to give us more guidance. But until then, it's something to talk about. Certainly our first look, as I mentioned, a new crop acreage. Explain this graph you've worked up for us.
I've talked about this all winter. Actually, I used it a lot a year ago, too, and talking about what's going on out there. I really brought this one back and just plugged in the 8 major crops, the planted acreage on them, because those are the numbers we get here from the USDA at this time of year. As we get into other reports, I'll go back to all acres planted to all crops, but it shows a similar picture. And the real detail that's important here, you can see that on the bottom, the colored lines, those are the spring crop insurance guarantees. For the wheat, it's actually a fall number when the winter wheat crop is being planted. But you can see as the crop insurance guarantees went up, which basically are tied to prices moving up, how we expanded acreage. First, back in 2008, we slipped off a little bit as we got into 2009 and 10, and then we really pushed it higher again when we got into those later periods out there. But for the last 2 years, you can see how we've lost total acreage out of the mix as crop economics have deteriorated and farm economics have deteriorated. Now this year, the first shot out of the chute in these initial acreage estimates from the USDA, you can see that we're losing quite a bit again here at this juncture. And to do this, as noted on the graphic, I plugged in 2.5 million acres of prevented planting, which is really the low end of what an average is. It gets down to the low side because we tend to have some of those every year. But with prices being down, crop insurance guarantees being down as noted here, and these will be pretty close to the numbers that we'll see here for the spring with February winding down. And farm economics actually worse than they were even a year ago. It doesn't surprise me that we're going to lose some more acreage altogether again. And we have to remember in the mix going back to around 2004, 2005, and states from the Rocky Mountains to the east, we had about 10 million acres that was pushed out of the CRP program, low quality acres. So if you're an area where you have low quality acres, and it's mainly in the Great Plains and in the South, if economics aren't good on high quality land, they certainly are really bad on low quality land, and that's the kind of land we're by and large going to lose.
Okay, in a similar vein here, Dale, we've got a discussion of farm economics as they relate to acres. We've got gross margins projected for Iowa corn and soybeans. Well, those gross margins are seemingly on the wrong side of our zero line, right?
Yeah, they really are, and I've looked at this a couple of different ways. These are numbers that came out of Iowa State back at the end of the calendar year. And if you look at corn following soybeans, you really see that, non-land costs account for about $2.74 a bushel at this point in time. That doesn't even factor the land into it. And frankly, when you start looking at a 387 crop insurance and start factoring in what kind of policy you might take, but even at the 85% level, I'm not doing much better than actually covering my non-land costs at this point in time when I look at it from that direction, and that even takes into account, yes, we're underwater. In the beans here, you see a similar story. Non-land costs on beans based out of Iowa State, $5.34 a bushel. Well, even at 85%, I'm going to find that with my beans, I'm still going to have probably a little bit better time of covering my non-land costs with the crop itself. But as you can see, when I look at the whole mix there, beans, I'm actually more underwater on my total costs than I am on corn generally. And I think that may be one of the factors that's kind of pulled some acres over to corn and away from beans, as we've noted on the acreage numbers the USDA put out here. But I really wonder if markets stay dull and sideways, if people are going to really start looking at, boy, I've got better potential of returning some money to land with beans than I do with corn, and we might not see this acreage shift change a little bit again by the time we put the crop in the ground.
Yeah, by the time we put this next crop into the ground, and certainly if prices remain as low as they are, and the crop insurance guarantees like we talked about, but maybe would you say a longer term phenomenon here in the acreage shift for our I states? We're looking at charts for Iowa, but these are very similar to those for Illinois.
Yeah, these are just representative. I've looked at the data for Illinois too. These are really representative for for both the I states here, and you could even say, you know, the high quality land in Minnesota, the good land in Indiana as well. You know, but you know, the point is we are underwater, and that's really a troublesome item when you keep looking long term. If we don't find some price relief here going forward, by the time we get into the next crop, you know, it's going to keep putting that bite on, then it's going to keep deteriorating our farm economic structure itself as well, which is going to keep putting pressure to keep trimming acres here in the U.S.
Okay, those are the acres numbers we got from the USDA out of the annual outlook forum yesterday. Today we got a look at some numbers regarding demand, our first plugging in of estimates for the 16-17 row crops here. As we go along, note that you can ask questions there on the box, and we'll see those and try to answer those before we wrap up today. Moving on to the balance sheet, we have, it looks like the wheat up first, and wheat, the big number here is that 51 million acre number, a number that hasn't been that low in many, many years, right?
Well, actually, when we go back and look at winter wheat plantings, I remember real well. I haven't looked with these numbers here at the total wheat planting, but winter wheat, we were like 33,000 acres over the modern day low. And that's data that goes all the way back into the 1960s. So we actually have a small wheat planting. You know, the trade was caught a little bit surprised here, you know, with the number on wheat. They were thinking actually a little bit higher than that because a lot of people weren't really believing that we were going to trim spring wheat acres. But in reality, when you look at the data, looking at spring wheat outside of Durham, we trimmed something like about 800,000 acres out of the spring crop here too. And again, much like it is with the corn, it goes back to economics. But when you look at wheat and you put a 45.9 bushel yield against it, and I think that's realistic at this point, given the fact that the last 2 years, you can see we've had yields that have been a little bit short of trend at this juncture. We really end up with a situation to where we have, again, a continuation of comfortable supplies in the U.S., and that's actually hoping that we improve our exports this next year, which with the competition in the world, unless something happens to that crop or unless we feed a lot of wheat, it's going to be hard to start tightening the wheat up in here. And so, you know, even though a lot of our listeners out there may not raise wheat, the wheat balance table needs to improve for the wheat market to get out of the way of the corn market. Otherwise, as corn goes up, you're going to feed more wheat, and it's going to be a lid to the corn market at this juncture. So don't lose sight of what's going on in the wheat market, even if you don't raise any. But we certainly have a comfortable situation here. And in the world, we're going to end up with a similar situation if, in fact, we don't have problems. But in deference to the wheat, right now, we're right on the cusp of the most important time of year. We're on the cusp of really going into the spring growing season where you really make or break a wheat crop. So keeping an eye on the weather of wheat over the next 3 months, not only here but around the world in the northern hemisphere, is going to be very important because it could have big implications back to corn. And there are a number of troublesome spots around the world.
Okay, keep those major points in mind then. We look at lower acres, but as Dale mentioned, after 2 years of slightly disappointing yields here, we've got a trend that still gives us a big crop that adds to big carry-in supplies even from the last two. And with weak exports, you know, a strong dollar and unfavorable trade terms for our exporters, we've got the folks in the Black Sea still gaining market share. Ultimately, we're left with some ending stocks that, as Dale mentioned, are comfortable and probably approaching that burdensome type term here. And we'll keep wheat in mind then if we're going to have some guidance for corn.
One other point to think about before we get away from this, look at the bottom line and the first estimate average price paid to farmers of $4.20. That's probably roughly right where we are right now at this point, which really kind of suggests, and the thing to take home from this too, we don't have a lot of downside risk in the markets at this point. And I think that's one thing you look at with the wheat market. in particular at this point, and you'll find it true as you look at the corn and the beans here the next couple slides.
Okay, that'll become important when we start to talk a little bit about prices and some objectives. But yeah, when you look at the average price paid to farmer at 420 and a futures curve that in Chicago is led by that 450 area, maybe that's a comfortable area of long-term support that we can maintain. Moving on to the corn sheet here, again, 90 million acres. That's a notable the notable number from this week's numbers out of the USDA, but 168 bushels an acre yield. We thought we'd get something close to trend. Is that really trend, do you think, Dale?
That's really pretty much a trend yield as it is, going back and looking at the USDA's weather-adjusted trend model, and that's what they used to come up with. That's pretty close to what they had used on the baseline numbers we first saw back in December, so it really wasn't so much of a surprise to anybody to see 168 bushel yield. We didn't until yesterday know where they were going to plug the acreage in, but at this point, nobody had too many qualms with neither the acreage nor the yield numbers they put out on yesterday and today.
Okay, so if you've got a growing crop, we do have maybe some growing feed use and residual growing herds. We've got exports maybe up just moderately, ethanol steady on the last year as far as our new crop projections. Certainly not very aggressive on the demand estimates here.
Well, I think they're pretty generous, though. I mean, you're sitting there going back to the demand we had here 2 years ago. We're facing a fair amount of competition around the world coming out of South America in terms of the corn export trade, and we've had some competition out of the Ukraine, and there's some talk there that we may end up with more corn acres, less wheat acres in Russia this coming year. So, to start out with a 1.7 billion bushel export number, and you look at a larger domestic demand base, and it's basically mostly coming in feed and residual. And I don't think that's an unfair number here either. We still end up with, I think, reasonable out of the chute demand numbers. And the interesting twist is that we didn't end up with a carry out over 2 billion. If we'd ended up with one over 2 billion, people might have felt a little bit more negative about it just from a pure psychological standpoint. Now, like I mentioned on wheat, that average price paid to farmer, $3.45, probably not a lot different than where we would be today, given the level that December corn futures are trading at right now.
Okay, so if we're somewhat optimistic about corn carryout, the first estimate not going above 2 billion bushels, can we be somewhat optimistic as well that we're not seeing, or that we're actually seeing soybean carryout drop on the year?
Well, the twist with soybeans there, and we went from 450 on the current crop down to 440 million on the new crop. It really comes back and starts to detail into what they use probably as far as demand. The trade was a little surprised they didn't raise the acres. The yield number is okay. So other than the acreage component maybe being a little less than they thought yesterday, nobody really has a quibble to make with the production estimate. But when they look down there and they're looking at a demand base that's going back to where we were 2 years ago, I think people are going to start to be a little bit quizzical at this point. But I wonder, and we've talked about this at different times via Farm Week, and the spokesman haven't not in the last couple of months, about how the USDA early on tends to underestimate soybean demand and its exports in particular, which is tied to world demand. You kind of wonder if the USDA finally didn't make some minor adjustments into their models and keep those demand numbers, especially the export number that you see, a little over 1.8 billion bushel, a little bit higher than they have traditionally started out with in the past, because in the past, over the last 25 years on average, their demand numbers averaged about 90 or 95 million bushel less at the end than they started at the beginning. So you really wonder if they haven't made that adjustment. So I'd be careful this year thinking that, well, we start out with a big number and it'll get smaller. maybe they've already factored in some of the demand adjustment they need to make.
So the demand adjustment for the new crop, okay, that's good if we're potentially factoring that in, but we've still got an old crop carryout that will very much be an input to our, of course, next year's ending stocks. And USDA tendency, as you mentioned, is to underestimate demand, and that for that carryout number to come down from here, currently at 450 million bushels for the 15-16 crop. What's the comment on USDA tendency for the old crop relative to a lot of expectations in the trade, which is that old crop number could still go up a little bit?
If anything, the old crop number may stick about where it is. And number one, you go back and you look at the export experience we've had here in terms of shipments over the last 3 to 4 weeks in particular, and it has been much better than what people were thinking it was going to be. We still have a big ship backlog down in Brazil. We've got long waiting times, to load boats, and so we're seeing some boats diverted back to the U.S., which kind of suggests that, the export number may be revised up slightly. But on the flip side, crush demand soft. We're finding that demand here domestically is a little soft. So you're kind of thinking that, maybe, just maybe, we might see this crush number come down a little bit. So we may end up with an offset where maybe exports get a little bit better, crush gets a little bit worse, and we still stay somewhere around the 450 million. But going back into the historical pattern a year ago, I don't remember if it was the Outlook Forum a year ago or the May a year ago, we were at 500 million on that then new crop carryout, and now we're at 450. So we've seen that same pattern.
Mm-hmm. Okay, we talked about the balance sheets. Again, the first look from the USDA at our new crop S&Ds, certainly not set in stone. Just like the acres, the demand certainly, the outlook for those components can change. Let's talk a little bit about price and some price objectives. We'll relate that to some AgriVisor marketing recommendations as well. The key here is that, okay, we've had some weakness here this week, in part caused by these numbers out of Washington. We're down back towards these long-standing lows: 350 corn, 450 wheat in Chicago, 850 beans. And that is going to play a very important role for near-term direction. Do the very bearish funds, are they able to gain some headway in pushing us lower than these long-standing marks? In the past, they've been unable to do so, even when they've amassed these record net short positions in the grains. We've got still some volatility in outside markets. Is oil bottoming out, or is it not? How about the volatility in global equity markets? Not to mention, we've got some pressure on the board in the near term because of some old crop inventory still left to market. All those things, I think, make me anticipate another couple to several, 4 or 5 weeks worth of sluggish trading or range-bound trade, one that really can't gain traction until we get closer to the planting season and into the early growing season, for that matter.
Yeah, I won't disagree with you at this point. I think the biggest thing that you take home right now in terms of, and you're seeing a wheat chart here, and you'll see it on the corn and the beans, is that I think downside risk at this particular juncture is getting rather limited right now. And you went back on the nearby contracts, and you talk about 450 and on wheat, and in corn you got 350, beans we have 850. All those seem to be in play. Timing counts. We're in a window here to maybe put a 40-week low in the wheat market, which if we ultimately get, it's probably going to end up shaking out as being not a 6-year low there. And we're also in wheat down against the lows we put back in 2009, 2010, or real close to them. So there's a lot of reason to think we don't have a lot of risk down, and having the funds with big positions and wheat in particular right now. If something does come along to change the rules of the game, we got a lot of short positions that are going to get blown out. Interestingly enough, when you go back into the crude market itself, and we were trading up over $34 here today at one point, if we get crude market on nearby contract up over the $35 level, as we get into the next number of weeks here, you're going to have a lot of people starting to talk about the possibility maybe we've passed some kind of a low in the energy market. And if that happens, then we see some commodity indices show those same flourishes, then you're going to have a lot of people starting to say, maybe commodity prices are done going down. And that just changes the psychology. But you're right, for the next number of weeks, it's going to take a while. The corn, we're in a window here, ideally mid-March, to put in a 40-week low. It looks to me like we're just checking out a low that, from a pattern standpoint, we had back in January, which looked like an important low. So I think once we get through this myriad here the next couple of weeks, that one there is going to turn up. And in beans, you see somewhat of a similar thing. And, we're chopping more sideways in November. We're in the window right now to put in a mid-cycle low. But I think, before we get too far into the growing season, we're going to have some opportunities to sell stuff at certainly better levels and significantly better levels than we have today. I'd say that, you'll punch somewhere up over 9.25 beans, and corn, I think you could probably talk 4.25 anyway. And then the wheat, it wouldn't shock me that we don't punch that back up. Let's say get in near to the $5 mark, if not even a little bit higher than that.
Well, that's been my point on my, our recent travels here, given market outlooks, is to say that, hey, I absolutely believe we're going to have an opportunity ahead, an opportunity that really allows us to be aggressive in wrapping up old crop sales, and one that allows us to take a stab at new crop marketing efforts. And where will that opportunity come from? I think it comes from weather. I think we take 2015 as a lesson here in thinking that we will likely have some sort of weather rally, whether it's during the planting season or early growing season, and that's going to give us a little bit of a boost here. But we got to realize, and also take into account that little weather market rally we had in June and July of 2015, that they can be very much short-lived. So we got to be ready to take action. And Dale mentioned 9.25 new crop beans. I'd say, 415 area. That's when we can start to really take a look at securing some hedges or some forward sales for the new crop. And I think we'll get that opportunity. Old crop, time running out a little bit here, in that we're still sitting on quite a bit of it. It has become in some instances in 2016 already somewhat of a headwind for markets if we get up to these areas of technical resistance, 370, 375 in the front of the corn curve, 890, a very important mark on the beans. We've seen some increased selling pressure, not just from the bearish fund traders, but also, as I'm talking about here, some increased interest from producers to let go of the old crop. What do you think on old crop, especially those guys that are still maybe standing with your recommendation in that they're holding some basis contracts they're about ready to need to price or roll?
I think the basis contracts, you have to do what's individually comfortable with you on the old crop itself, but I think you probably gear up to roll because, the way the thing's coming together here and with the timing on the corn in particular, with a 40-week low in March and probably, like you say, going to be sluggish coming out of the chute even once we do put a low in place. It may be into the early part of summer before we really see what I'd call really a good opportunity. So if you got them against the May, you got to get them out there somewhere against the July contract maybe. But I'll go back. The one thing I think, a lot of our customer base has to kind of get used to in this environment anyway, is checking what's going on in the wheat market. Because wheat is the first that's teed up in here to go into its key growing season. And so if you start seeing excitement there, you're going to start seeing excitement across the corn market along with that, and even to a degree in the beans, as people scramble to kind of adjust and what does it mean and how does it impact planting, and a whole bunch of different axioms here. And whatever happens with wheat, what are maybe some implications for growing season weather for corn and beans in the summer? So, the wheat market can cause or help create or help foster a whole readjustment and attitude of thinking here that may end up playing out. But one bigger thing that I kind of rely on that's still important is that when you look into the bigger cycles themselves, other than these short trading cycles, we're still in this window. Crude oil and commodity indices both, we're towards the end of it, and it looks like we're trying to make a bottom, but we haven't confirmed it yet. But this could be a 3-year low, and that ultimately means, you could have a window here that's 12, 18 months long where commodity prices in general could certainly be a little bit better. So it's going to be a thing you have to watch this structure develop. For those of you that have been in the business for a while, you go back and you remember, in days of yore, the 90s, the 80s, grain markets always went through this long period of basing to build the next move. And once you broke out and started to move, it rolled, and it rolled hard. So, we may be setting up something like that again. We'll just have to see how it comes together.
Okay, well, overall, Dale, it looks like you and I agree in the sense that from price objectives and marketing recommendations, it's hard to want to be a big seller down here at these lows, 350, 450, 850. So as long as these hold up, we can start to gain some traction, but we won't be surprised if that doesn't happen until, mid-March and beyond, once we start to get into the crop especially. And that's especially, again, the case when we have some of these active weather patterns of strong El Nino leaving us and potentially a La Nina coming in. If anything, that's some fodder for the speculators who are holding a big net short and would likely cover. And so we're not big bears here. We've got some optimism, I think, to extend to folks, but we'll encourage them to keep track of the advice. Again, if you are listening, you're likely a member of the Illinois Farm Bureau or the Iowa Farm Bureau, and that means you have free access to our service. Please take advantage of it as best you can. Thanks so much for listening to our webinar. We appreciate your participation and your business with AgriVisor.